Have you ever stopped to think about what our entire global financial system is actually built on? I mean, at its core, it's not just concrete banks or fancy trading floors. It's built on a single powerful idea. And think about it, this one idea, it has shaped everything, from the way we price stocks to how we plan for retirement. It's a concept that promises order, that promises predictability, in a world that, let's be honest, often feels pretty chaotic. So what is this big idea? Well, it's the belief that market returns are normal, that they follow this beautiful, tidy bell curve. It suggests that most of the time, the market just makes small moves, and that the really huge, crazy events, the massive crashes or the epic rallies, are so ridiculously rare, they're basically a statistical impossibility. Sounds comforting, right? But what if that's all it is? A comforting story. What if that foundational assumption, the one that trillions of dollars are riding on, is just fundamentally wrong? What if the real world doesn't play by the textbook's rules?
Well, that's exactly what we're going to dig into. We're going to pull back the curtain and see what history actually shows us. And spoiler alert, it's a very different picture from the neat and tidy world of the bell curves.
Okay, so take a look at this. That smooth line, that's the theory. That's what the model says should happen in a perfect world. But the jagged bars, that's reality. That's what actually happened with the S&P 500. And you can see the problem right away, can't you? Look at the edges, way out on the left and right. See how many real-life events spill way outside the neat little curve? In the real world, the tails are much, much fatter.
And let's put some hard numbers on that. The model predicts that a massive drop, what the quants call a 3 sigma event, should only happen once every 1,000 months. That's about once every 83 years. But in an actual 83-year stretch, you know how many times it happened? 10. 10 times. The model wasn't just a little bit off, it was off by a factor of 10. What the theory calls a once-in-a-lifetime crisis has been showing up about once a decade.
And that, my friends, has a name: fat tail risk. It's the simple but game-changing idea that extreme events, the black swans, happen way more often than the textbooks say they do. As one paper put it, you're far more likely to get wiped out by one single catastrophic event than by a slow series of small losses. And once you really get that, it changes absolutely everything about how you have to think about risk.
So, if we accept that we live in this wild, fat-tailed world, what do we do about it? If crashes are a much more normal part of the system than the models admit, how on earth do we prepare for them?
Well, the most obvious answer is to just buy insurance, right? In the financial world, that usually means buying put options that pay off when the market tanks. But here's the catch. That kind of insurance is super expensive. Both theory and history show that if you're constantly buying these puts, it's a losing game over the long run. You just slowly bleed money on premiums, which makes it an incredibly tough strategy to stick with.
But what if there was a smarter way? Check this out. Instead of constantly paying for protection, what if your protection could actually make you money? This chart shows a strategy called trend following. It's basically a system that just tries to ride the big waves, up or down. Now just focus on the green bars. During 9 of the 10 worst market crises of the last century, we're talking everything from the panic of 1907 to the 2008 meltdown, this strategy actually made money. It didn't just protect, it profited.
And hey, trend following isn't the only tool in the toolbox. Researchers have pointed to a bunch of other strategies that tend to do pretty well when the stock market is having a bad time. Things like focusing on solid, defensive companies that people need no matter what, or using these global macro strategies that can adapt to whatever the economy throws at them. The key idea here is to build a portfolio that's tough, that's robust, not one that's just crossing its fingers and hoping for the best.
But you know, this rabbit hole goes even deeper. The whole fat tails problem? It's really just a symptom of a much more fundamental mistake in how we think about finance. It gets to the very core of what an average return even means. It turns out we might be averaging the wrong thing entirely, and this is called the ergodicity error.
Okay, whoa, I know this equation looks terrifying, but seriously, ignore the symbols for a second. The idea behind it is actually pretty simple. It's about 2 different ways of looking at an average. One way is to imagine a million parallel universes, with a million versions of you all making one bet at the same time. Let's call that the ensemble average. The other way is to look at just one version of you, in your universe making that same bet over and over and over again through time. That's the time average. Now, ergodicity is just the fancy word for assuming those 2 averages are the same. But here's the dangerous part. When it comes to your wealth, they are absolutely not the same.
Let's just break that down to make it crystal clear.
The ensemble average, that's the multiverse view. It's the average result across all possibilities at once. It's what most economic models are based on. But we don't live in a multiverse, do we? We live the time average, one single path, one outcome after another. And for something like your money, where a bad outcome can wipe you out, those two averages can be worlds apart.
Here, let me give you a simple example. Let's play a game. I'll toss a coin. If it's heads, you gain 50% of whatever you have. Tails, you lose 40% of your wealth. Now, standard economic theory says you should take this bet every single time. It's a no-brainer.
And here's why the theory loves it. The ensemble average, the multiverse view, has a positive 5% return. On paper, it's a great deal. But what actually happens to you if you play this game over and over again? That's the time average, and your likely outcome is a negative 5% return. You would almost certainly go broke over time, even though the average outcome says you should be getting rich.
This chart just says it all, doesn't it? That beautiful blue line rocketing upwards. That's the ensemble average. It's the path of wealth the models tell us about. And it looks fantastic. But all those gray lines? Those are the individual paths, the paths that real people are on. And where are most of them heading? Down, towards that red line, which is the time average. Mainstream economics is obsessed with that blue line. But you and I, we live on one of the gray ones.
Okay, so markets have fat tails. The average isn't what we think it is. So where does that leave us? What do we actually do? Well, it means we need a fundamental shift in our mindset. We have to move away from trying to be predictors and focus instead on becoming survivors.
So here's the new playbook. First, we have to accept that massive crashes aren't bugs. They are features of the system. They are going to happen. Second, because of that, our goal can't be to perfectly predict the next market move. It has to be about building a portfolio that can take a punch, or 10, and still be standing. And third, this means the things that really matter aren't trying to time the market. It's stuff like how much you invest in any one thing, how you spread your money across different assets, and honestly, your own discipline to not freak out when things get scary. And you know, this quote just wraps it all up so perfectly. It's not about trying to dodge every single swing. It's about making sure you can stay in the ring long enough to be there for the long-term trend. The real question isn't, can you predict the future? It's, is your portfolio built to survive it?